What if a single $100 bill could rewrite your future or vanish in a heartbeat? The stock market is a wild, heart-pounding arena where millionaires are made, dreams are shattered, and stocks like Nvidia or AMC explode with a single X post. Ready to unlock the secrets to conquering Wall Street in 2025? This video isn't just a guide, it's your do-or-die shot to master the game and build life-changing wealth. Don't even blink. Miss 1 second, and you're missing the key to your financial freedom. Let's dive in. Have you ever wondered how people turn a few $100s into millions, while others lose everything in the blink of an eye? That's the magic and mystery of the stock market. But here's the thing. Once you truly understand how it works, it stops being a mystery and starts being a tool you can use to build real wealth. So let's break it down, step by step. The stock market is simply a marketplace. But instead of buying apples, clothes, or electronics, here you're buying pieces of companies. These pieces are called shares. When you own a share, you literally own a part of that company. If the company grows and makes more money, the value of your share goes up. If the company struggles, your share loses value. That's the core idea. In the United States, the two most famous stock exchanges are the New York Stock Exchange, NYSE, and the NASDAQ. Think of them like giant online supermarkets where stocks are listed and traded. The NYSE is home to giants like Coca-Cola and Walmart, while NASDAQ is known for tech powerhouses like Apple, Amazon, and Tesla. Now, how does the price of a stock change? It's all about supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Simple, right? But here's the twist. These buy and sell decisions are influenced by news, earnings reports, global events, interest rates, and even social media hype. Remember GameStop in 2021? That was a perfect example of how online communities can send a stock skyrocketing almost overnight. Companies list their stocks on exchanges through a process called an IPO, initial public offering. This is when a private company decides to sell shares to the public for the first time. For example, when Amazon went public in 1997, its stock was just $18 per share. Today, after stock splits, that investment could be worth hundreds of thousands of dollars. That's the power of long-term investing. There are two main ways investors make money in the stock market. First, capital gains. This is when you buy a stock at one price and sell it at a higher price. Second, dividends. These are regular payments companies make to their shareholders, usually from their profits. Some investors love dividend stocks because they provide passive income, even if the stock price doesn't move much. But here's a truth most beginners don't realize. The stock market is not a quick rich machine. It's more like a wealth-building marathon. The most successful investors in history, like Warren Buffett, made their fortunes by buying great companies and holding them for decades. The stock market rewards patience, discipline, and knowledge, not gambling instincts. There are different types of players in the market. Day traders buy and sell within the same day, looking for small price movements. Swing traders hold stocks for days or weeks to catch bigger trends. Long-term investors buy and hold for years, focusing on the company's long-term growth. Each strategy has its own risks and rewards. So why does the stock market even exist? Because it's a win-win system. Companies get money from selling shares, which they can use to grow their business. Investors get a chance to own a part of those companies and profit from their success. Without the stock market, businesses would have a much harder time raising money, and ordinary people would have fewer opportunities to grow their wealth. Technology has made the stock market more accessible than ever. Decades ago, only brokers in suits on Wall Street could trade stocks. Today, anyone with a smartphone and a few dollars can start investing through apps like Robinhood, Fidelity, or E-Trade. This democratization of investing is powerful, but it also means more people jump in without understanding the risks. That's why education is key. Before you invest, you need to understand the company, its industry, and the market conditions. You also need to manage risk. Never invest money you can't afford to lose, and always diversify your portfolio. Diversification means spreading your investments across different companies, industries, and even asset types, so you're not dependent on just one thing going right. The stock market is a reflection of human psychology. Fear and greed drive short-term movements. When people panic, they sell, pushing prices down. When they get overly excited, they buy without thinking, pushing prices up. The best investors stay calm when everyone else is emotional and they stick to their strategy. In the long run, the U.S. stock market has historically gone up, despite wars, recessions, and crises. That's because the economy grows, innovation continues, and businesses adapt. If you stay invested in strong companies, time is your biggest ally. So next time you hear someone say the stock market is just gambling, remember this: gambling is random, the stock market is not. It's a place where knowledge, patience, and discipline can turn small beginnings into life-changing results. The question is, will you treat it like a casino or like the greatest wealth-building machine ever created? The choice is yours.